Dave, great to see you there. You have won the competition of best setup of office at Fisher Funds. Looks super professional there, and I'm actually kind of jealous, to be honest. It looks pretty awesome. So
it's all smoke and mirrors, Frank.
Absolutely. Dave, we're going to talk about fixed income today and what's going on in global economics and global fixed income markets. Central banks have obviously been really active at looking to support the global economy through the coronavirus crisis. Can you just give us a bit of a flavour of what's been going on with central banks, both in New Zealand and offshore, and the effect that will have on helping the economy through this crisis?
So first and foremost, they've cut the overnight interest rates in their jurisdictions down to or very close to zero. So they've now entered what we would call the lower bound. So they really can't get too much lower in many respects. But there's also a lot of countries that were already close or at or even below zero going into the crisis. So they've extended what used to be, I guess, called unconventional monetary policy, which has now become a lot more conventional since the global financial crisis of sort of 2008 and 2009. And that unconventional policy is called quantitative easing, or QE for short. That's certainly been the main weapon in their arsenal, and even those banks like the central bank here in New Zealand, the Reserve Bank of New Zealand, has not only cut that overnight interest rate down to close to zero, but again, they have also initiated quantitative easing. So what that means is they're basically committed to buying a lot of debt instruments out of the market, so bonds out of the market, in an effort to drive down the cost of borrowing across the entire economy. The view initially was that by dropping down that interest rate, that would encourage more borrowing and that would stimulate the economy through spending and investment. But I suspect now that actually QE is kind of morphed into the lowering of interest rates, really trying to safeguard households and companies when it comes to the servicing of their debts, keeping those costs down so that they actually don't default.
Okay. Can you just maybe give us QE 101, because it's a word that we read about in the paper, we hear on the news, but I'm not sure that I entirely understand what the mechanics of it are, how that affects the banking system, what are central banks buying, how does it actually operate?
Yeah, sure. Okay, so QE is often called money printing. And it's not, it really is not. So that's the biggest misconception in the first place. There is actually no new money created that goes into the actual economic system. QE is actually the exchange of just one asset for another. And that exchange takes place between the central bank, say in New Zealand's example, the Reserve Bank of New Zealand, and our regular high street banks that we all know and love. So when the Reserve Bank of New Zealand embarks on QE, they are buying New Zealand government bonds, for example. They have actually extended that to other bonds in the New Zealand debt markets as well most recently, but let's just use New Zealand government bonds as the example. They would buy them from that high street bank, and in return they would credit the account, the settlement account of that bank, which has a deposit account with the Reserve Bank itself. So it's really just switching one asset, the government bond, from that high street bank's balance sheet, and replacing it with a reserve or a credit on that account. So that doesn't increase the balance sheet of that bank. It increases the balance sheet of the Reserve Bank, but that money doesn't flow into the system. What's required for that to occur is that a loan has to be originated off the back of that from a high street bank. So high street banks actually create money. The central bank does not. The real benefit though of QE is that it can, if it's done in big enough size, it can actually drive down, like I said, drive down the interest rates in an economy. So by buying enough of one instrument, it will obviously reduce its interest rate or its expected return. And that can stimulate the economy through, as I say, more investment, more borrowing, or at least just safeguard households and companies by reducing their interest cost.
Okay. If I read the comment section at the bottom of any article, and it's always a bad thing to do, but if I read the comment section, anytime the word QE gets used or the words QE gets used, the very the comment that always comes through is this is going to cause inflation. We're Germany in 1938. We're going to have rampant hyperinflation because central banks are being irresponsible. Are those comments right, or should we be looking at it a different sort of way?
Well, they can be right, but most often they're wrong. That's probably the most simple answer that I can give you. So, which isn't a great one, but let me just explain it. In the current doses of QE, I think inflation is going to be unlikely in the near term. You know, QE, although it's pretty new to our shores here in New Zealand, has actually been around for a very long period of time. Most people heard of it start to come into sort of mainstream media post the global financial crisis. But in fact, Japan had entered into quantitative easing well before then. They're actually, and don't quote me on this, I think they're up to version 24 of QE. Right, and they have still had 2 decades of deflation or disinflation, or very, very, very low inflation, even with all of this what people call money printing, which again it is not. So I don't think it's actually inflationary, because we've got lots of examples, and really quite recent ones and fairly long-term ones that suggest inflation actually isn't that easily created. So the point that I'd make, Frank, is that that's no surprise. I'm not telling you or our viewers anything that they probably can't see themselves. That Japan hasn't been able to create inflation despite all of this QE. Okay,
we might need to get you answering some of those comments that I read in the paper there.
Yeah, and I love these sorts of debates, because I think there is, as I say, this mischaracterization that doesn't really that doesn't fit the narrative that people are often trying to paint. But so as I say, I'm not telling you I don't think anything that a lot of people already know, but again, why QE is potentially successful and why central banks continue to roll it out in greater and greater quantities is, again, driving down interest costs to make the cost of borrowing less and safeguard the economy from higher servicing costs. The other point that I would make, though, when it comes to inflation, is why it can be inflationary, is actually the hope is that by lowering interest rates, so if they're successful in lowering interest rates through QE, that actually might cause the currency to fall, the currency of that economy to fall. Why would that fall? Well, it would largely fall because if interest rates are lower, then the expected return from debt instruments in that country are going to be much less attractive to an offshore buyer. So if offshore buyers are less interested in buying New Zealand dollar denominated fixed interest assets, they're therefore going to have less demand for the New Zealand dollar as a currency. That could cause it to fall, and therefore the input costs, I guess, of the lower dollar could actually create some inflation in the economy. There's 2 caveats to that, is that one, it's a zero-sum game. Everyone is trying to do that around the world at the moment. And so you can't all create inflation by all having a lower currency, because currencies are obviously a pair between one another. And secondly, what often happens is that when QE is being launched, like it is now, we're in some form of crisis or some sort of downturn. And so there is actually already strong deflationary forces creeping through the economy right now that QE may only just offset, not actually creating inflation, just making it less deflationary.
So as you say, interest rates are low pretty much everywhere around the world right now. If you were to think about your outlook from here, do you think those low rates, particularly for government bonds, will continue to stay low around the world, or what's your view for the next 6, 12, and 18 months?
I think interest rates are going to remain low for as far into the future as my imagination can take me.
I suspect it's a long way.
Which I think is a long way. Now, there's a lot of reasons for that, and I won't bore the viewers too much with it, but to summarize, there are some structural dynamics that are at play here, which have been at play before the crisis, and I'll touch on some of the more shorter-term cyclical impacts that the crisis is creating. But the big structural dynamics I call the 3 deflationary Ds. That's too much debt in the global economy, that is an aging demographic, and the disruption that digitalization and technological advancements are having on the cost structure of goods and services around the world. So those are strong deflationary effects that I think are still going to be pushing through the global economy for quite some time, and keeping inflation low, and therefore keeping interest rates low.
That's a real anchor on inflation, yeah.
Correct.
Yeah.
That is exactly it. That's a good way to describe it, as that anchor. Then on the more short-term cyclical impacts, what we're seeing right now because of the virus is we're seeing a dual demand and supply shock that is really pulsing around the entire global economy. What I mean by that is that suppliers can't get supplies to their end markets, to consumers, because certain parts of that supply chain are being disrupted, either through lockdowns or through potential defaults or failures from companies along that chain, and that is causing supply to be constrained. On the other side, we're seeing demand being constrained because we're all at home. We can't go out to shopping malls. We can't go out to restaurants. People are losing their jobs. Unfortunately, we had another unemployment number out of the US this morning, which looked shockingly bad again. So now we have over 22 million unemployed people in just the last month in the US filing for some form of benefit now. That out of interest wipes out all of the employment gains in the US since the end of the global financial crisis in 2009. So we've got some big shocks that are still pulsing through the global economy, and will keep interest rates and inflation and growth, unfortunately, down for quite some time to come.
David, in our portfolios, we lend to companies as well as corporates. In the jargon of the market, we talk about that as a credit spread, or the extra return for lending to companies. Can you just give me a bit of a flavour of how that credit spread has changed over the course of the crisis, and what opportunities you are seeing and lending to companies in our portfolios?
Well, it's changed, and it's changed for the better from an investor's perspective. So that is to say that the extra interest rate, this risk premium or credit spread, like we like to call it in the industry, has actually risen, and that's a good thing, because that means that your expected return from investing in a corporate bond, as opposed to, say, a more safe haven government bond, has actually increased. Now, that makes a lot of intuitive sense, given what I've just told you about how kind of mediocre at best, if not quite alarmingly bad, the global economy looks right now. So as you would imagine, lending your money, or buying a corporate bond, they're the same thing, but lending your money to a company in a time of great uncertainty is going to associate itself with a lot more risk, that company might not be able to repay you those funds when they come due, or the interest on that loan. Whereas obviously a government has many other avenues in which to be able to pay you. So the risk, credit risk, default risk, whatever you want to call it, of lending to a corporation has increased in uncertain times. That makes total sense. So the catch is that there are greater returns on offer by investing in corporate bonds, for sure. But the flip side is that ensuring that you're selecting the right companies to lend to is more important than ever.
Can you just maybe then give me a couple of names of companies that you think look really attractive right now, and where you've seen some opportunities?
Yeah, one of the most attractive opportunities we see at the moment is in European and US banking champions, for want of a better word. And the reason that's the case is that, in stark contrast to the global financial crisis, the banks are actually in pretty damn good health right now. They're going into this crisis with capital levels considerably higher than they've had for decades, and they have also reduced down the types of risky lending that they used to do in the lead up to the global financial crisis. So their balance sheets are a lot cleaner than what they used to be. The other key point that I'd make is that they're also going to be key beneficiaries of a lot of the government and central bank support that is now being put in place. Why is that the case? Well, central banks and governments realize that the banking industry is the conduit for getting that support, that stimulus to the people that need it most, the companies, which are the clients of the banks, or households, which are again clients of the banks. These are they're important distributors of the stimulus to safeguard the economy. So I think they're in for, yes, a rough time, as clearly there's going to be pressure on their earnings from both companies and households getting into trouble through this, but they are in very, very good health to be able to safeguard themselves from that, and again they're going to benefit from those from that support. The other point that I'd make, and another area that we are finding some value in, is that we're trying to think about who are going to be the winners coming out of this crisis, and the global economy is going to look a lot different than what it did only a few months ago before we went into lockdown. The areas that we think are going to benefit from this are telecommunications, pharmaceuticals, and, lo and behold, things like on-demand TV. It doesn't take a rocket scientist to figure those things out, but equally, I think, given the uniformity of the sell-off, so the sort of the indiscriminate sell-off that's occurred through March, you've seen really good companies being negatively tainted by what's going on around them and going on around in society. Take Netflix, for example, on the on-demand TV side of things. There is a once in a generational shift from linear to on-demand entertainment. And Netflix is the clear front runner to reap the spoils of that. That was happening well prior to the COVID issues that we're now facing, but they are really accelerating now as people obviously are starting to enjoy the great content, I guess, that platforms like
Netflix has not just become a good TV to watch, but it's become the world's best babysitter.
That's a great point. In fact, I think I've got it on in the other room right now for my youngest daughter watching nursery rhymes. So yeah, you're exactly right, Frank. It's been fantastic to be able to take some attention away from us. So this was a clear example where the market got caught up with itself, threw the baby out with the bathwater, and that actually some of the competition concerns that Netflix had been facing got amplified in the market and got distorted. And so we've taken advantage of that and stepped in to buy some of those, buy some of the bonds that company issues just in this last quarter.
Tremendous. Hey, Dave, thank you so much for your time today. It was a really, really interesting chat. Chat soon. Cheers.
No problem. Cheers.
Thank you.